Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Phil Mackintosh, chief economist at Nasdaq. Phil, it's great to see you as always. Welcome back from your travels. It's good to see you again.
It's been busy.
It has been busy.
A lot of things going on.
And one of them is the debt ceiling. And basically the issue is it's the trajectory of the debt that has people concerned.
Yeah, I mean, this is something that's become really controversial, and I guess the media might be playing down the controversy part of it, but the reality is we have debt levels on the government side that are pretty close to the levels we had at the end of the Second World War, and higher than we've had for basically most of the last century. So a lot of debt, and the problem with having a lot of debt, it's just like in your house. Eventually your interest costs are going to start to chew into your budget. And so the reason that people don't want to just keep spending, and we're running pretty big deficits right now, is because we might end up, if interest rates go up even more, with a lot of our tax dollars going into interest payments. So it's not a simple solution of just spending more.
So if we take a look at your next couple of charts here from a historical perspective, how does it impact volatility in the markets? And of course, what does that mean for stocks?
Yeah, so now we're talking about why it's important that they do resolve this problem, because the markets hate uncertainty, and things like potential default of the US government, which is one of the risk-freest assets, would be a really big deal for financial markets, a really big deal for stock markets too. So if we look at what happens, we've had 3 previous near defaults, and every single time volatility in the stock market has increased. If you look at the chart, you can see 2013, 2021, volatility increased before what's called the X date, where things were resolved. Although obviously in 2021, what ended up happening, the first resolution was to kick the can down the road about 40, 50 days, and then it all happened again and volatility spiked. The biggest problem that we potentially were facing this time was we had our credit rating downgraded from AAA to AA+ in 2011, and that has never been pulled back, and it created a whole lot of volatility for a long period in the markets. It also created a big sell-off in the market. So if you look at the other chart, the market actually sold off nearly 20% because of the credit rating downgrade. And even without that, the uncertainty ahead of the X date for the other two, you saw the market sell off as well. So that's not great for companies, not great for anyone trying to raise money in the equity markets. It's going to cost them more to finance new projects.
So with the current deal, really all it does is cap spending limits.
Yeah, I guess the good news is that the negotiations kind of came to a decent compromise where the current level of spending is going to be kind of capped going forward, basically. So the impact on GDP for this year and next year is just incrementally weakening it, not a massive contraction in spending and stimulus from the fiscal side. So all the forecasts that we've had running into this are basically unchanged, which is why the market, when it saw the resolution last weekend, is like, you know what, that's actually a pretty good result, because we're not going to suddenly pull the rug out of the economy. We've got some slowdowns. If you look at all the data we've been talking about on forward orders and manufacturing sector and the housing sector already, we don't need to make it worse, and this doesn't seem to make it worse.
But it still doesn't feel like they resolved anything from a structural perspective. Has anything fundamentally been resolved with the exception of, okay, it's been capped?
No, in terms of like changing the fiscal outlook of America and whether we balance our budget, that's not resolved. And it's something that they've basically pushed out to the next administration 2 more years away.
All right, Phil. Appreciate the insight as always. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, global markets reporter at Nasdaq.